Today I'm going to go over 6 different dividend stocks that are all recession proof. We'll start off with looking at how the stock is within this past year, then go back in time to the financial crisis in 2008 and look at the revenue and also the net income during that time period. Then we'll end with if Wall Street analysts see these stocks as the buy right now, and then also my personal price targets. If you're ready, let's jump in. First stock on the list is Walmart, ticker symbol WMT. And within the last year, Walmart has grown about 26%. And within the last month, it has fallen about 0.5%, bringing it to a current share price of $149.91. Over in this 52-week range, it's getting very close to its 52-week high of $164. It is trading at a current PE of 24.09 and it has a decent dividend yield of 1.52% with an annual payout of $2.28. Moving over to the income statement, looking at the revenue around the 2008 time period, you can see here during the time of the financial crisis, there really was no drop for Walmart. It continued growing throughout that time. So about 2006, we had $321 billion. And just moving forward in time to about 2010, we had 426 billion. So there was no drop, and that's very good for Walmart during the time. So scroll on here for the net income, and we pretty much see the same thing. Around 2006, we had $11 billion, and through 2008, we had almost $13 billion, and Walmart continued to grow past that time to 2010 with almost $15 billion. So that's great for Walmart during this time. Wall Street analysts are considering Walmart as a buy right now with the low of $145 and an average of $165. So that'll give you an upside of about 10.5%, which is pretty nice. And currently analysts are estimating an increase of Walmart's earnings per share from about $6.14 to about $8.45. And then scroll down here to the revenue. And once again, analysts are estimating that the revenue will grow from $612 billion to about $729 billion. Now, as my personal assumptions for Walmart, over here looking at the historic values, for the revenue growth, I have 3%, 5%, and 7%. Both for profit margin and free cash flow margin, I have 0.5, 1.5, and 2.5%. For PE and price to free cash flow, I have 16, 18, and 20%. And then 10% return. So scroll down here. Now, based on my assumptions, the current share price of Walmart is overvalued. Ideally, I'm looking at Walmart around the 130 price range. This key right here will be between my mid and high assumptions. So that would be the range I'm looking at to add a position into Walmart. Next stock on our list is Costco, ticker symbol COST. And within this last year, Costco has grown over 17. And just within the last month, it has grown close to 0.5%, bringing it to a current share price of $496.52. Costco is just above their midpoint of their 52-week range, and they are trading at a PE of 34.43. They have a dividend yield of 0.62%, which will give you an annual payout of $4.08. Now over on the income statement, looking at the revenue, right over here, a few years before 2008, we had a revenue of $55 billion, and just going right through, you can see that Costco continued to grow throughout that time to about 2010, it had $74 billion. So definitely was one of those companies that people flocked to buy items in bulk. So scrolling down here for the net income, just like the revenue, we had net income around $1 billion, and through the 2008, it continued to grow. So there was no big dips during that time. And in 2010, we had $1.4 billion. So definitely was increasing during there. Now, as far as the Wall Street analysts, they are considering Costco as the buy right now with a low of $475 and a high of $635 with an average of $546. That'll give you about a 10% upside from the current share price. Now, right now, analysts are estimating Costco to continue to rise for their earnings per share from $14.78 to about $21.84. Scroll down here for their revenue growth, and they also are seeing the revenue to grow over the next 5 years from $247 billion to about $319 billion. Now, as for my own assumptions, for the revenue growth, I have 7, 9, and 11. As for the profit margin, I have 0.5, 1.5, and 2.5. Free cash flow margin, I have 1, 2, and 3. And then for PE and price to free cash flow, I put 18, 20, and 22 with 10% return. Scroll down here, you can see here that the current share price is in between my mid and high. As far as a good price target that I'm looking at is around that $450 range. So I do feel that Costco is slightly overvalued for my own assumptions. But I think around the mid 400s is a good price target for Costco. Next on the list is a place where everyone flocks to get coffee. It is Starbucks, ticker symbol SBUX. And within the last year, Starbucks has grown nearly 47%. And within the last month, it has fallen close to 2%, bringing it to a current share price of $105.51. Now, as far as Starbucks during this 52-week range, it is getting close to its 52-week high of $115. It's currently trading at a high PE of 30.69 and has a nice dividend yield of 2.01%, which will give you an annual payout of $2.12. Over on the income statement for Starbucks, looking at their revenue, going back to 2006, we had about $7 billion, and through 2008, it was $10 billion, and pretty much stayed $10 billion till about 2011. So what is good about that is that they were able to stay pretty stable during that time. Scrolling down here to the net income. Now looking at net income in 2006, we had about $550 million. In 2008, we had $633 million, and we did have a drop in 2009. However, Starbucks was able to quickly rebound from there, which was great to see that fast recovery. Wall Street analysts are also considering Starbucks as a buy right now, with a high of $136 and an average of $115. That'll give you about 9.5% upside from the current share price. Now, analysts are estimating for Starbucks to continue to grow within the next 5 years with a earnings per share of $3.48 to about $7.19. And scroll on here for the revenue. They also see that the revenue grows over the next 5 years from $36 billion to about $56 billion. As for my personal assumptions, looking here at the revenue growth, I have 6, 7, and 8%. A profit margin of 9.5, 10, and 10.5. Free cash flow margin, I have 6, 8, and 10%. For PE and price to free cash flow, I have 16, 18, 20 with 10% return. And scrolling on here, that the current share price of Starbucks is a bit overvalued. The price target I'm looking at is more close to $80, which will be in between my mid and high assumptions. So that's where I look at when investing in Starbucks. Next on the list is Caterpillar, ticker symbol CAT. Within the last year, Caterpillar has grown close to 4%, and within this last month, it has also fallen about 4%, bringing it to a current share price of $214.78. Now, Caterpillar is just above their midpoint of their 52-week range, and they are trading at a PE of 12.05 and have a nice dividend yield of 2.23%, which will give you an annual payout of $4.80. Over in the income statement, looking at the revenue for Caterpillar, going to about 2006, we could see that they had revenue about $37 billion, and through 2008, about $46 billion, and had a slight drop in 2010 to $31 billion, but was able to quickly recover from that. So that was great for Caterpillar. Now scroll down here to the net income. About 2006, we had $3 billion, 2008 around $3.5 billion, and we did have a drop just like the revenue in 2010 and was able to quickly recover to what it had in 2008. So great to see there. Now, as far as Wall Street analysts, they are considering Caterpillar as a hold right now with a low of $175 and a high of $345, which will give you about an average of $242. And that's about a 13% upside from the current share price. Now, analysts are estimating growth in Caterpillar, but it looks like a slow growth at that. So we have earnings per share of about $16 to about $20. Going on here for the revenue, and we do see the next couple of years kind of stagnant, and then we'll pick up some growth. So revenue will be around $64 billion to around $76 billion. Now for my personal assumptions of Caterpillar, for the revenue, I have 1, 2, and 3%. For the profit, I have 7, 9, and 11. And for the free cash flow margin, I have 7, 8, and 9. And for both PE and price to free cash flow, I have 12, 14, and 16, and a 10% return. So scroll down here, I'm looking at the current share price being overvalued as well. And the price target I'm looking at is around $170, which would be in between my mid and high right here. So that's the price target I'm looking at for Caterpillar. Next stock on the list is Darden Restaurants, ticker symbol DRI. And this one surprised me a bit. Looking here, Darden Restaurant covers Olive Garden, Longhorn, Cheddar's, Yard House, Bahama Breeze. Once we get into the data, you can see that even during a recession, people still like to eat out and celebrate. Within the last year, Darden Restaurants has grown 38.5%, and within this last month, it has grown over 6%, bringing it to a current share price of $161.41. Now, Darden Restaurants are at the high of their 52-week range, and they're trading at a PE of 20.32. They have a very nice dividend yield of 3%, which could be an annual payout of $4.84. And over on the income statement for Darden Restaurants, looking at the revenue, going back to around 2006, we have revenue about $5.5 billion. Through 2008, we had close to $7 billion. After that, pretty much stayed around that $7 billion range with an increase in 2011. So really nice for Darden Restaurants to see they didn't really have any drops during that time and were able to continue growing. Going on here to net income, going back to around 2006, we have $341 million. Around 2008, we had $384 million, and through then was continuing growing its income. So very nice to see for Darden Restaurants. As far as Wall Street analysts, they are considering Darden Restaurants as a buy right now, with a low of $143 and a high of $180, with an average of $163. So that's about 1.5% upside from the current share price. Now, analysts are estimating that Darden Restaurants continue to grow over the next 5 years for the earnings per share from $8 to about $12. And scroll on here for the revenue, $10.5 billion to about $13 billion. So nice steady growth for Darden Restaurants. As for my assumptions, looking at the revenue, I have 3, 5, and 7%. For profit margin, I have 6, 7, and 8%. For free cash flow margin, I have 6, 8, and 10%. And for both PE and price to free cash flow, I have 14, 16, and 18% with 10% return. So scroll down here. The current share price is between my mid and high. And as far as a good price target, I'm looking at closer to $150 range. So Darden Restaurants is definitely getting close to that, which is nice to see. So if Darden Restaurants does pull back a little more, it'll be a great time to start picking up some shares in this company. Now, the last company on our list is Tyson Food, ticker symbol TSN. Now, over the last year, it has fallen over 40%. And within the last month, it has fallen close to 18%, bringing it to the current share price of $49.96. Now, Tyson Food is very close to its 52-week low of $47. It's currently trading at a PE of 30.68, has a very nice dividend yield of 6.84%, which will give you an annual payout of $1.92. Over on the income statement of Tyson, looking at the revenue, over in 2006, they had a revenue of about $25 billion. And through 2008, around $27 billion, and since then has steadily been growing. So great to see for Tyson. Scrolling on here to the net income. Looking at 2006, they had a negative $175 million, was able to recover very nicely in 2007, but fell again in 2008, with 2 years later, really rebounding from there. So good to see that a nice rebound after 2008 and have been growing since then. Now, as far as Wall Street analysts, they are considering Tyson Food as a buy right now with a low of $48 and a high of $103, with an average of $61, and that's about a 23.5% upside for the current share price. Now, analysts are estimating nice growth within the next 5 years for Tyson for the earnings per share of $4.34 to about $9.75. Scrolling in here for the revenue growth, we have about $55 billion to about $58 billion. So nice to see there as well. Now, as far as my personal assumptions for Tyson Food, looking at the revenue, I have 1, 2, and 3%. Profit margin of 1, 3, and 5%. Free cash flow margin of 1, 2, and 3. PE and price to free cash flow, I have 8, 10, and 12 with 10% returns. So scrolling on here, looking at the current share price is close to my mid assumptions, and I am looking for around $50 as a good price target. So definitely hitting that target right now. And in my own personal portfolio, I am picking up some shares of Tyson. So definitely think it's a good time to invest in Tyson if you choose so. There you have 6 recession-proof dividend stocks that you can add to your watch list or even your portfolio. If you enjoyed today's content, let me know by smashing the like button, and also drop a comment down below what your thoughts are about each of these 6 stocks. If you want to see more stock analysis, definitely check out the video right over here, and I'll catch you over there. Have a blessed day. Peace.